Hello my fellow freedom builders and welcome back to the channel. Today we're going to look at yet another strategy that is completely automated and almost completely passive. We're going to look at Ray Dalio's all-weather portfolio. Some of you might have heard about it, but I'm going to show you how it is constructed today, and I can guarantee you that it is a portfolio everybody can put together. So today we're going to have a little look at who Ray Dalio is. We're going to look at how his portfolio is built. I'm going to show you a little back test of it so we can see how it has performed over the last 10 or 15 years. And yes, that's about the program for today. First of all, before we go any further, if you like what I show you here, I would really appreciate it if you could pay me a little click on the subscribe button just underneath the video. That's all I ask for. So let's get to it. Who is Ray Dalio? You might want to know a bit about him before you start to use some of his strategies. If you have read Tony Robbins' book about money and building wealth slowly over a lifetime, then you might have stumbled upon Ray Dalio's name because he is one of the persons that Anthony Robbins is picking brains from in this book. So that is where many people have seen the all-weather portfolio for the first time. But Ray Dalio has been talking about it for quite a number of years. Now, Ray Dalio is not just anybody that just invented a strategy and tried to sell it. Ray Dalio is running his Bridgewater's hedge fund. I think it has been running since 1975 or 1978, something like that. So he has been in the game pretty much forever. And he is one of the big guys in the game. You can see here, Mr. Dalio, who sounded an alarm this year over rising income inequality, earned an estimate of $2 billion in 2018. As far as I recall, 2019 was a bit of a bad year for him. He only made about $1 billion there. Who can live off that? But I'm pretty sure that he will stay up in that range between $1 and $2 billion each and every year. And of course it is because he's running a hedge fund where he's getting some sort of performance fee, but he also has a lot of skin in the game in his own portfolios here in the hedge fund. So he's just not a Mr. Nobody. I can really recommend that you study him. He is worth listening to. But let's get to his strategy. What he's using, or at least what he's recommended to ordinary people like you and me, is using ETFs. And I have been talking about ETFs before. It stands for Exchange Traded Fund. And as the name tells you, it is traded on the exchange, just like any stock, and it is a fund. So it is an exchange traded fund, and it often consists of a number of it could be mostly stocks, but it could also be bonds. It could be some futures. Then it is often called an ETN instead, but it's pretty much the same. So an ETF can have a lot of different vehicles or instruments inside it. Let's say it is the SPY called the Spider. That's an ETF that covers the S&P 500. So it mirrors the S&P 500. If the index go up 5%, then the ETF goes up 5%. There might be a slight 0.01% difference once in a while, but it pretty much mirrors it perfectly. So ETFs is an easy way to get some diversification, and they're often very cheap compared to, for instance, mutual funds. Many of the large ETFs are down to 0.2, 0.3, sometimes only 0.1% in yearly fee for running them, because the guys inside, they do not want to, they're not needed to have some really clever guys, quants or something like that. They are simply mirroring a market, so they don't have to figure out which stock to pick and so on. So what the Ray Dalio all-weather portfolio is about is to get a mix of ETFs that gives you a coverage and a diversification in the market that makes sure that no matter what kind of market we are in, if we are in a market crash, if we are in a bull run, if we are in a low inflationary environment or a high inflationary environment, or whatever kind of situation and macroeconomic situation we are in, this portfolio should be pretty stable. And there is a reason why I didn't start making this video just last year, and I'll show you why. Now here we have the Dow Jones Index, and I started my channel here in November 19, and the reason why I didn't show you this strategy before is that it is not the best of strategies when it comes to an extreme bull market, because it rarely beats the market in a really hard bull market, in a really hard bull run, as we saw in 19 and as we have seen pretty much for the last 10 years with some small breaks in between. So if I had started in November last year telling you about this strategy that made maybe 6% or 7% on average per year, every single year, then you would have thought I was crazy, because who doesn't want 25% for a year? As many new investors experienced last year, those of you that came into the market for the first time last year could have had a good chunk of this bull market, and you were pretty much feeling invincible. But then, of course, came this part, and that all of a sudden makes people quite a lot more motivated to learn about Ray Dalio's strategies, because the entire essence of his strategy is to make sure that you don't lose too much in a crash. So he's actually running from Warren Buffett's old quote saying that rule number 1 is never lose your money. Rule number 2 is never forget rule number 1. And that is what it is all about. So what you can see here is that he has actually quite a small chunk of money in stocks. Only 30% of his entire portfolio is in stocks. And I'll show you what kind of stock-based ETF in a second, but let's just go through this little diagram here. Then there are some long-term bonds, and that is government bonds. So that is US government bonds mainly, and there are some intermediate term bonds. So this is out in, I think it is 10 to 20 years, and this is down in, is it 1 to 3 year bonds. But I'll show you the ETFs in a second. Then he has some gold and he has some commodities. And that's pretty much it. So if you have $100,000, let's say you had that, you would put 30,000 in the stock ETFs, you would put 40,000 here in the long-term bonds, 15,000 in the intermediate, and 7,500 in each of these two. So that makes $100,000, and that is how it is constructed. So let's have a quick look at it in a little software that I often use. Just a second, here it comes. The software is called Etf Replay, and it is not a free software, so I'm paying a subscription for it, but I'm using it a lot because it has all sorts of backtesting features, and many of the papers you can test on is going back to 2003, 5 or 7, something like that. That was in the period where the ETFs were really gaining some traction. So what I've been doing here is that I've made a little portfolio called All Weather, and that consists of GLD, which is the gold ETF. We have the GSG, which is a commodity ETF, and then we have IEI, which is that was 3 to 7 year bonds, and we have the TLT, very well known long-term treasuries, and we have the VTI, the Vanguard Total US Stock Market. You could choose the S&P 500 here if you wanted to, but most people recommend that you use the VTI. It covers a bit broader market. So what we do here is, now I have put the start date down in 2003, but I'm pretty sure they only have it from 2007, something like that. But we're saying test portfolio, and what this piece of software, this is the most simple part of the software. You can use all sorts of different advanced functions, and that is what I'm using when I'm building my ETF strategies, where I rotate every 2 weeks or every month between the different ETFs. But if you have some money and you're starting the year out and you're thinking, I do not want to spend any time on this investment, I just want to put my money into something where I'm pretty sure I don't lose it all, then you could have this allocation here. Now we have tested the portfolio, and if we scroll down, we can see that right now I'm benchmarking. My benchmark is SPY, and yeah, we can use that one. This will of course underperform the S&P 500 because the S&P 500 is 100% stock based, and the stock market always tend to win over the long run. But when we are talking this, and I'll get back to the numbers in a second, then it is underperforming slightly, but actually not as much. When I did this test back around New Year, it was underperforming a lot because the stock market has gone up, and the all-weather portfolio hadn't really run this fast. So we can see here that since, since the 5th of January 2007, this one is running. That is because that was the first time where all of these 5 ETFs were in play. So it is almost performing as well as the S&P 500 right now after the big drop. But what is really interesting here is to look at the volatility, where the S&P 500 has a standard deviation of 20.7% or a historic volatility of 20.7%. Then this all-weather portfolio is only having a volatility of 7.6%. And what that tells us is that we are getting a lot less drawdown, a lot less risk. I know that some of you are saying, well, I don't care about the swings in the market. They could swing all it like. I just want to keep for the long run, and in the long run, 100% stock-based portfolio will win. And yes, it probably will. However, you could have started your investment right here and needed your money for something, purchasing of a house or covering the cost of a divorce or whatever you spend your money on. So you could have put your money into the stock market right here, and then there is the volatility risk that you might actually need your money at a point where you're 50% down. You could have lost 20-25% here. You could have lost 25% here. You could have lost 35-34% here. So there are plenty of big swings in the market. And if you know you're not gonna use your money for the next 30 or 40 years, then a 100% stock-based portfolio might be the right thing for you. Remember, I'm not a financial advisor. I'm just telling you how to, some inspiration as to how to build this. So what I'm saying here is that the reason for building the all-weather portfolio is that you're pretty sure that you're never going to see a complete crash in your portfolio. And if we're looking at some of the other numbers here, then we can see the CAGR, that is a compound annual growth rate, meaning that if we were to go from 100 to something up here around 250, you would need 6.9% per year. So that is what this one is making. It is making 6.9% per year and has been doing so since, for the last 13 years or so in very volatile market. The SPY has made 7.6%, and that is a bit more, but it is also with huge drawdowns. As you can see here, the max drawdown of the all-weather portfolio was around 16%, so the worst time of all was 16%, whereas the S&P 500 in 2008 were down 55%. You can also see it here in the Sharpe ratio. The Sharpe ratio is a way to measure the performance divided by the volatility, the standard deviation calculation here. And the higher the number, the better. And the professional investors are tending to go for portfolios that can make, or strategies that can make something like 0.7, 0.8, maybe 1.0 in Sharpe ratio. But you can see the SPY is actually down at 0.35, and that is because it has an okay CAGR, but with an enormous high volatility. So what you're getting here is you're giving a bit back on the performance but you're gaining a lot as for volatility. We can see here, year on year, you can see what it has made, 12.9, 0.7, so on. There was a losing year in 09, which was a great year. You can see the S&P 500 was up 26.4% in 2009. So this one, in 2009, the strategy underperformed the market with 30%, and that is of course a lot. Then it had a winning year here, but still underperforming the market. In 2011, it made 16%, where the S&P made around 2%, so it outperformed here. So you can see every time we have a green number here, it is because we have outperformed the market. So the tough years, you could say, the 2008 was a tough year. It outperformed the market with almost 38% here because it didn't lose money. Right now in 2020, where the market has really been down, was down around 34%. Well, this portfolio was only down around 15%, and you can see that is outperforming massively here. So as you can see, if you choose an all-weather portfolio, it is 100% automatic. There are not a lot of costs involved here, but what you can see is that there will be a lot of years where you are underperforming the overall stock market. So you should never go for the all-weather portfolio if you're looking for a constantly double-digit performance every single year. But then again, you're not getting that in the S&P 500 as well. You're just getting a bit more over the last 13 years, 7.6%. So that is the number you should try and beat, and not necessarily beat just in percentages, but beat in Sharpe ratio, where you're also looking at the drawdowns and the volatility. All right, so as you can see, this is a neat little piece of software where you can pretty much do whatever you like. You can shift this out, you can do whatever you like. You could say, what if I took only 2% in gold and 2% in the commodities and took the other percentages and spread out, and you can play with the numbers. Just be aware that when you're back testing, there is a tendency, a danger, a pitfall that you could drop into here, and that is what is called curve fitting. And that means that you keep refining your strategy and say, now what if this was 7.7 instead of 7.5, and this was 30.2, and you keep fitting into the best possible scenario, and then you start investing in it, and often these curve fitted portfolio, they crash at the same second you put them on. Whenever you see an advertising for some sort of trading system that has a equity line that goes something like this, giving you 10% per month, and the drawdowns are just so small you can hardly see them, then you can be 100% certain that this is a curve fitted back test they're showing you. They're just showing it to you to sell some fancy system that doesn't work. So is this the right thing for you? Well, I shouldn't be the judge of that, since I'm not a financial advisor. You can see that there have been certain times in history where it has been very good to be in this strategy, and certain times where it has been less good. As you can see here, I'm not sure, it is a bit small. I'll try to enlarge it. Here we go. It is a bit blurry. I'm sorry about that. I took this screen dump. I'm sorry I haven't even got a source on it. Sorry for you if you're sitting out there saying that this is your graphic. I took it from a website. I'll try and find it again and then put a link to it below, so we have the sources right here. So what this shows us is that these colors are showing either -3, less than or worse than -3%, or between -3 and 0%, between 0 and 3, between 3 and 6, between 6 and 9, and above 9. And then you can see if you started in, let's say, 1985 here, and you kept it for 5 years. Let's just have a look here. 1985 and kept it for 5 years, then you would have made above 9% per year. But if you started in 1985 and you kept it for 20 years, then you would have made, let's see, somewhere between 6 and 9%. However, if you started in 1973 and kept it for 2 years, you would have lost more than 3% per year. So we can see this. Of course, it is always dependent on when we start. And if you go long enough with this, you can see that if you hold it more than 10 years, then we are pretty much in the clear. Then you are making sure that you are in the positive every single year if you have held it for at least 10 years. So then you are on average above zero. Of course, there's also some inflation, some different things to account for, but this is a rock solid strategy. And you can see, as I showed you, just a second, let's go back to that one. You can see that here, this year, where the S&P is down around 12%, the strategy is actually up 6%, and it did reasonably well as well in 19. So this is something you need to consider if you don't want to lose your money. So if you have gone into the market here and you said, well, I could easily take a loss, and then you experienced a 35% drop in the market, and you experienced this horrible thing of not being able to sleep at night, and you were thinking about stocks all the time in the worst possible way and considering if you should just sell everything, and maybe you sold everything just at the bottom just before it started to go up again, well, then I would urge you to consider something like this. There's a little website I can show you. It's called the Lazy Portfolio. Let's just see here. LazyPortfolioETF.com. And they have a lot of these different automated portfolios in here. You can see they have the Lazy Portfolio list. That is a 10-year treasury portfolio with only one ETF. You can see there's an aggressive global income portfolio with 80% in stocks and 20% in fixed income. If we click on that one, we can see some numbers in here. You can see it has been doing, let's see, 5.59% per year, standard deviation here. And you can see all the numbers and what kind of ETF you should be in. You can see how it has performed over the years. So in here, there are a lot of different, the Alpha Architect Robust Portfolio and Andrew Tobias Portfolio. What do you know? There are lots and lots of them, and they are all automated so that you just once per year maybe reallocate. And that is another thing I'll just mention to you here. And that is that this strategy is not 100% automated, because around once per year, maybe once every 6 months, if you want to be a bit more active or the market has moved violently, then you could consider at least after 12 months to reallocate when we are talking about the all-weather here, Dalio's all-weather portfolio. Because it might have been that the stock market has gone completely crazy and have gone up with 100%. That doesn't happen often, but let's just say then all of a sudden these 30% would be a lot more than 30% of the entire portfolio. So you want to reallocate and recalculate this at least once per year, just to make sure that one of these asset classes is not completely under allocated or over allocated in your portfolio. But that's pretty much it. It's once per year. You can choose these ETFs. You can try and play around with them here. You can try the Etf Replay. I can't remember the price. I think it's not very cheap. I think it's around 30 or 40, maybe $45 per month, something like that. I'm using it a lot, but if you're only using it very quickly, then you can just book it for 1 month, and you can test it out and do your back test, and then cancel the subscription again. So I love the tool. It is very good, very stable, and it is absolutely something you should consider if you are an active ETF investor with a reasonable size portfolio. That's all for now, and I hope this was a bit of an inspiration as to an automated strategy. Remember to subscribe to the channel. If you like this video, please give it a thumbs up down there, and that's about it for now. I'll talk to you again soon. Bye for now.